Welcome to Easy Gen Z Finance. Let's talk about money, and more importantly, about building a secure financial future. In a world where the economy is always changing, understanding how to make your money work for you is key. One of the most powerful tools to grow wealth over time is investment funds. In this video, we'll break down what they are, why they matter, and the main types of funds you should know about. By the end, you'll have a clear foundation to start building your own investment strategy. An investment fund is a pool of money that provides access to many investments from one purchase. Think of an investment fund like a layer cake with many layers. Each layer represents one investment in the fund. When you buy a piece of the cake, you buy a small portion of each layer via one purchase. Therefore, when you buy a share of an investment fund, you end up owning a small portion of each investment in the fund. These funds are professionally managed portfolios, meaning experts make decisions about what to buy and sell. Investment funds give you diversification, which spreads your risk across many investments, liquidity, so you can buy or sell relatively easily, and access to markets that might be hard for an individual investor to reach on their own. Of course, they're not risk-free. Funds can fluctuate with the market, and they often come with management fees, so it's important to know what you're investing in. Two well-known financial voices, Rick Edelman and Dave Ramsey, both see investment funds as a core part of building wealth. Rick Edelman emphasizes asset allocation. That's the idea of balancing your money across stocks, bonds, and cash to manage risk and build a stable foundation. Dave Ramsey takes a simpler approach, focusing on spreading investments across a few types of mutual funds for long-term growth. Their methods may differ, but they agree on one key point. Diversification and discipline are essential. There are many kinds of funds, each with a unique role in your portfolio. But today, we'll focus on 7 core categories: money market funds, government bond, corporate bond funds, US stock funds, foreign stock funds, hybrid funds, sector funds. Money market funds invest in short-term, low-risk debt. Their main goal is to preserve your capital and keep your money accessible. The pros: low volatility and easy access to your cash. The downside: returns are usually low and may not keep up with inflation. These are often used for short-term goals or emergency cash buffers. Government bond funds invest in US treasuries and similar securities. They're known for lower risk and predictable income. Pros: safe and stable. Cons: interest rate and inflation risks. These funds are great for adding stability to a portfolio. Corporate bond funds invest in debt issued by companies. They come with moderate to higher risk, but often higher yields than government bonds. The trade-off: more potential income, but also more exposure to credit risk and interest rate changes. US stock funds invest in American companies of all sizes. These funds often serve as the growth engine of many portfolios. They offer strong long-term growth potential, but they can be volatile, especially in the short term. Foreign stock funds invest in international companies. This adds global diversification to your portfolio. Pros: exposure to global opportunities. Cons: currency fluctuations and political risks. Investing beyond the US can help balance your portfolio during domestic market downturns. Hybrid funds combine stocks and bonds into a single investment. They're convenient for investors who want built-in diversification and a more balanced risk profile. The trade-off is less flexibility, since the fund manager decides the mix. Sector funds focus on specific industries like technology, healthcare, or energy. If the sector does well, returns can be impressive. But because they're less diversified, they carry higher volatility. Many investors use them as satellite investments, not as the core of their portfolio. To wrap things up, investment funds give everyday investors access to diversified, professionally managed portfolios. Different fund categories balance risk and return in different ways. A smart portfolio usually combines several types of funds to create a well-rounded investment strategy. Whether you prefer Rick Edelman's asset allocation approach or Dave Ramsey's simpler framework, the goal is the same: diversify, stay disciplined, and think long-term. If you found this helpful, give this video a like, share it with someone starting their investment journey, and remember, the best time to build your financial future is today.